Howdy, Jacob here. Today we're looking at Medifast. I just want to say I've already looked at this company beforehand, so it's going to be tough to not take into consideration what I've viewed within it. But I'll still point out all the financials that I can and just use a little bit of the knowledge to explain more in depthly. So currently 9.69% dividend yield. It's a $740 million market cap with a $584 million enterprise value. So net debt is actually positive on cash in comparison to debt. We can see that they have about 88 million in cash equivalents, and short-term investments, and they do not have any long-term debt. They just have accounts payable, accrued liabilities, tax liabilities, and capital leases, but no, it doesn't appear from high level that they have any interest-bearing debt. They are pretty heavy cash cows. Last 5 years, roughly 180 million, 60 million, 140 million, 70 million, 60 million, probably averaging about 100 million in free cash flow, 5 year average. They've been buying back shares pretty heavily in 2021, 2022. The dividend payout, if we're looking at a 5 year average, is about 70%. All right, so now I'm going to get into interesting. So 2017 to 2018, huge growth. From 2018 to 2021, the company 5x'd. It wasn't, I mean, I'm not seeing any acquisitions here, but it could have been acquisition related. Okay, so looks like the company's pretty consistent at using their free cash flow to do a mixture of dividend payout and buying back shares, at least historically. Whether they keep doing that is a different story. But um, so some I know, after reviewing the company before, they're actually cutting the dividend down to nothing. So this doesn't actually meet our dividend requirements, but I will still continue to make assumptions given the numbers that I'm seeing right here. So we can see that with no debt, they're still producing immense return on invested capital, which is partly dampened by the repurchasing of shares. So if a company buys back shares, that affects their balance sheet and minimizes retained earnings. And so when you calculate return on invested capital based on um, their net operating performance uh, with their balance sheet, it gets a little inflated because the denominator is getting lowered, which would increase the actual um, percentage here. So we can see that they were averaging about 20%, which is still immense, from 2013 to 2017, and then absolutely exploded 2018, 2019, 2020. It's a mixture of them just increasing their um, operating income as well as buying back a good amount of shares. But I think if we start to get to some assumption setting here, maybe let's say as for the revenue growth, there was negative in 2014, 2015, but it has been hugely positive since. It's in the weight management. Huge drop in recent 12 months compared to 2022. Um, Another thing I know about them is that they're cutting their dividend to make an acquisition. And the acquisition, they're currently a company that uses coaches and healthy food to try to produce weight loss for their clients. And the clients have historically been converted into coaches. So, very interesting business model. But they're starting to get into the weight loss industry with medication, whether that be through um, pills and everything. So their business model is going to change quite a bit, I would presume. I didn't look specific, or I don't recall how much the acquisition is and what their revenue earnings are in comparison to what the company does right now, and how they'll even be able to to use or how they'll incorporate the weight loss pills with their actual program. So that might take a little bit to truly pan out, but I think we can still be conservative and say, maybe there's 0% growth, 10p price to free cash flow, 15% return. Maybe the margins might get dampened a little bit due to just unknowing. Like, we just don't know what's going to happen with how they're going to incorporate the weight loss items. And then, maybe buy back 1%. All right, so that's going to get us to a price that is quite a bit lower than today, 45% lower to get a 15% return. I think that's 0% is a little silly. So let me do maybe 2%, 13, just because if they do decide to reinvest in themselves rather than just pay out through dividends and buying back shares, they should have a massive return on that money. So this gets us a way higher than it was before. This is just because I've researched it before, so I want to research it again. And with the initial assumptions, we're saying it needs to fall 17%, but it doesn't hit our dividend yield screener at all. So this would not be included into your dividend yield. Companies, due to them cutting the dividend to focus on their changed business model. So just keep that in mind if you're looking at this. Yeah, the 9% dividend looks attractive right now, but they're going to cut it. And so we can't assume that going forward they're going to have anything for the next 7 years. So we're going to have to really be banking on our increase in actual business itself. So, all right, thank you, and I hope you have a great rest of your day.